Imagine two gladiators in Bitcoin arena, Marathon Holdings and RIOT Platforms, battling for mining supremacy. Once a scale beast with 60 exahashes hash rate and 50,000 BTC holdings, the other has a strategy of monetizing megawatts by selling power back to the grid for significant profit. Who's going to win the battle? I'm Shivam, and today at Neural Net Worth, we are diving deep into company dynamics and operational efficiency to find out which of the two Bitcoin mining beasts would dominate in 2026 and 10x your portfolio. Stick around for the final verdict. Now, let's dive right in. First, let's talk about company dynamics. Marathon Holdings, formerly Marathon Digital, pivoted from patents to Bitcoin in 2020. Today, a global powerhouse with sites in Texas, Nebraska, and beyond, leveraging immersion cooling and S21 Pro miners for top-tier performance. In Q3 2025, they hit $252.4 million in revenue, up 92% year-over-year, with a net income of $123 million, mined 2,144 Bitcoin with a total BTC holdings of 52,850 coins as of September 30th. But the stock is down 30% year-to-date. Current market cap is $4.4 billion. Shareholders' equity is $5.15 billion. That's cheap. Moving over to RIOT Platforms, previously RIOT Blockchain. They are Texas-centric. They are masters of grid flex, curtailing power during peaks to earn credits, netting $50 million in Q3 alone. In Q3 2025, they showed a record revenue, $180 million, up more than 100% year-over-year, with a net income of $104 million, mined 1,406 Bitcoins with a total Bitcoin holdings of 19,250 coins as of September 2025. The stock is up almost 50% year-to-date. Currently, the market cap is $5.6 billion and shareholders' equity is $3.5 billion. Now, let's talk about operational efficiency. We are talking hash rate per dollar, cost per BTC, and margins. Straight facts from Q3 2025 filings. Starting with Marathon Digital, which leads with 60 exahashes hash rate, mining 23.5 Bitcoins per day in Q3. Mara deployed more than 155,000 miners, converting more than 230 containers into immersion cooling at Wolf Hollow, boosting uptime by 15%. But here's the kicker. Mara's direct cost per BTC is $39,235 in Q3 on average. Their global operations mean pricier logistics and transition to owning their own data centers and energy sources results in high costs. Mara reported an average fleet efficiency of 18.6 joules per terahash for Q3 2025, with an energized hash rate of 60.4 exahashes per second. 32% of their hash rate comes from mining operations below 20 joules per terahash. Q3 gross margin is around 31%. Moving on to RIOT, which has a hash rate of 38.4 exahashes per second, mining around 15.36 BTC per day in Q3. They have deployed microBT machines with a fleet utilization of around 95%. Cost per BTC just under 46,324 in Q3. That's even higher than Marathon Digital because of new infrastructure spendings and lower uptimes. RIOT reported an average fleet efficiency of 20.5 joules per terahash as of November 2025, with a deployed hash rate of 36.6 exahashes per second. Gross margin is higher than Mara at 59%. Now let's talk about growth potential. They both have pivoted to AI HPC but haven't started generating revenue from the pivot. Here we will look at some of the future revenue they are projected to generate. Analysts like Macquarie Group has projected Marathon to generate $6 billion worth of HPC revenue by 2028 from 35% capacity shift plus full Exaion integration. Average 2026 total revenue forecast is around $2.1 to $2.8 billion, 40 to 50% of it coming from AI HPC. Price targets reflecting AI upside are at $23 to $37. That's a 100 to 200% increase from current price. Moving on to RIOT Platforms, Nidam Group and JPM has projected it to generate $1.2 billion to $1.6 billion annualized AI HPC revenue once 600 megawatt Corsicana site is fully leased, which would be around mid-2026. 2026 total revenue forecast is at $1.4 billion to $1.9 billion. 30 to 45% will be coming from AI HPC. Price targets reflecting AI upside are at $20 to $27, 80 to 120% from its current price. Bottom line, Mara currently has slightly more live AI compute and the bolder $6 billion revenue headline number, but it's still pre-revenue and capex heavy. On the other hand, RIOT has zero AI revenue today, yet trades at a premium because of its 600 megawatt shovel-ready Dallas adjacent site, which is viewed as the faster path to larger hyperscaler leases. Analysts give Mara the higher absolute dollar potential, but RIOT the higher probability of execution and better risk-adjusted return in 2026. Before we move on to the conclusion, please like and subscribe if this video is adding value. Time for the final verdict. My suggestion, don't go all in. Diversify according to your style. I would do 80% Mara for offense and 20% RIOT for defense. I like aggressive plays and Mara is on the path to aggressive growth. What are your thoughts? Are you team Mara or team RIOT? Let me know in the comments. If you want to watch my 6-factor analysis I did on Marathon Digital, click here. Or if you want to watch the 6-factor analysis of RIOT Platforms, click here. Thanks for watching. I'll see you in the next video. Until then, take care and invest wisely.